Greetings, it is time for our monthly inflation update. Now, as always, inflation dominates most of the financial media and even the non-financial media because the media has a vested interest in making you angry or frightened. Therefore, they have convinced a large portion of the population that A, inflation is always bad, and B, that inflation is much higher than it really is. And this is dangerous because a lot of people are being habituated into believing that deflation would be good and a politician that runs on deflation could get votes. And deflation is a lot worse than inflation for the reasons I explained in this video that you see in the upper right hand corner over here. Deflation is far worse than moderate inflation. But the media is in the business of making you angry or frightened. Always remember that. So we go over here to my multi-dimensional inflation measurement, which takes into account three different metrics. The 10-year compound annual growth rate of the US CPI. We take 10 years to smooth out any short-term noise. The 10-year compound annual growth rate of the Goldman Sachs Commodity Index, and this is the most important measurement of the three because A, this is worldwide, B, this cannot be rigged because it comprises of commodities that are freely traded daily. One of the narratives that is pushed among all the people trying to scare everyone about inflation is that the US government underreports inflation rates. That is not true because the Goldman Sachs Commodity Index is not something that can be rigged, and the United States is not the only country in the world. A lot of inflation mongers and gold bugs seem to think that the United States is the only country in the world. And then the third measurement is the 10-year US Treasury Yield. Now, this is a measurement of future inflation expectations. It is not about the past or even short-term rates, but it is a measurement of future inflation expectations, and it's also the 10-year note that I take because that is the most issued US Treasury within the long end maturity of the US Treasury yield curve. And I choose 3% across all of these, even though a 10-year Treasury yield of 3% is extremely low by historical standards. But we are in an age of technological deflation, and it's even hard for this number to be above 3%, let alone the US CPI 10-year compounded annual growth rate, or the Goldman Sachs 10-year compounded annual growth rate. So now we shall see what each of these three measurements are. So as always, for the US CPI, we go to the bls.gov website, which will be in the description box below, and we go to Consumer Price Index, clicking on this little graph icon over here. So in the formatting options, we want to check a variety of time windows and measurements. So we choose the absolute data value. We don't choose 1 month, but we choose 2, 3, 6, and 12-month percent change. So we retrieve data. Now over here, we can see the actual CPI, and it looks like it's rising, but remember, this is an exponential measurement in a linear vertical axis chart. So the way to calculate the 10-year compounded annual growth rate is to take this number, 297, divided by the number exactly 10 years prior, 232, and then take the 10th root of that number to get the annualized number. So 297 divided by 232, 1.28, so 28% inflation over 10 years. So per year, that is x to the y power 0.1, the 10th root of 1.28. I hope everyone understands the arithmetic about how that is done. 1.025, so 2.5% a year remains the CPI annual growth rate over this 10-year window. And the 10-year window matters. The people who want to say that inflation is high, they are very selective about what starting point they tend to take. I am consistent in taking the 10-year window, and that means current slightly high inflation that may be popping up for a couple months is also going to be in this 10-year window for a long time. Now, is this moderating? 2.5% a year. But see, this is a 2-month percentage change. That's already past its peak. The second derivative is already gone for that. And we see the same thing in the 3-month percentage change. The second derivative is already gone. Doesn't mean it can't come back, but it takes a lot for that to come back. In the 6-month window, the second derivative has moderated substantially, and the annual CPI measurement is already peaking over here. It's still above 8%, but that 8% has to be weighed in accordance with the times when it was close to zero, like over here in 2020, the start of the COVID-19 pandemic, and all of 2015. That's when we were slipping into deflation. So you have to take the average of all of this to get a holistic picture, and 2.5% a year happens to be the average, as we just saw. The media will tell you inflation at 8.3%. Yeah, but they are taking exactly only this 1-year measurement. When it falls, they won't be anywhere to be found. This is the annual trailing 1-year measurement, but the average of 10 years from here up to here October of 2012 to September of 2022, is 2.5%. It can thus fall off as quickly as it rose, as we saw from the earlier percentage change windows of the 2, 3, and 6 month charts. So the US CPI is growing at 2.5% a year. Next we go to the Goldman Sachs Commodity Index. This is the Goldman Sachs Commodity Index, and the website link is in the description box below. And the 10-year average of the GSCI is minus 0.47%. Minus 0.47%. Deflation and a non-trivial amount of deflation. Forget inflation, this is in deflation, and this is, as I mentioned before, the most important measurement of the three, because commodities are what comprise what increases cost for people versus what decreases cost for people. Inflation also has a wage increase component tied to it, such as service price inflation, but that becomes more ambiguous. If inflation is high because of services price increases, that means someone's wage is also rising, and a lot of PhD economists don't understand that, hey, if service prices are increasing, the customer of the service is paying more, but the provider of the service is making more. So it's ambiguous about whether inflation is bad for whom versus not under those things. But within commodities, always lower is better. And this is in deflation, minus 0.47%. And I always take the 10-year window. Some people like to criticize and say that this is a plateau from which I'm taking a 10-year window, but it's a rolling 10-year window. And the peak price of oil was actually in 2008, $147 a barrel. It was not less than 10 years ago. It was in fact 14 years ago. Now eventually I'm going to take a commodities measurement equation because I will prove that we are reaching a point in the technological economy, the high-tech age, where no amount of money printing can make commodity prices rise at 3% a year. We are close to an infinity on that front. That doesn't mean that money printing can be infinity, because there's more to the economy than just commodities, but we are reaching one of these pre-singularity milestones when we talk about this. So Goldman Sachs Commodity Index, minus 0.47%. This is a bundle of everything: oil, natural gas, gold, silver, everything. And remember, to believe that gold or silver is going to rise after so much quantitative easing, trillions upon trillions upon trillions of dollars of quantitative easing failed to make them rise, means that a bet on any inert commodity, such as gold or silver, is effectively a bet against all technological progress, number one. And to believe that money printing could make gold and silver rise in price a lot is effectively to believe that no one ever made any money by producing and selling software. So to be a gold bug, you would also have to believe that nobody actually made money in the production of software. So that is why being a gold or silver investor and expecting that to rise is reaching a point of intellectual bankruptcy, as I talk about a lot on this channel. So now we go to the third and final measurement, which is the 10-year US Treasury yield. So 10-year US Treasury yield, and yes, this one is actually shooting very high. It's 4.21%. That's well above the 3% measurement that I said. Notice how there was resistance at 3%, and it was below 3% for most of the last 5 years. This is a 5-year chart. But now it has shot all the way up to 4.21% and is rising still because the Federal Reserve is deprinting money. Quantitative tightening is going on, and not just the US Federal Reserve, but in all major central banks of the world, which is exactly what they should not be doing, as I explain quite often on this channel, because this is going to crash the US housing market, which will require more printing than ever before, but it will also require printing of a new dimension than was done before, because they can no longer just buy treasuries and mortgage-backed securities as a method to pretend they're not printing money when they're printing money, because they've caused different distortions in the market. The Federal Reserve is run by PhD economists who know nothing about the real economy and are very theoretical and don't think anything is wrong in terms of increasing volatility in the economy and increasing uncertainty and reducing anyone's decision-making ability down to trying to predict what the Federal Reserve will and will not do. It's crazy, and it's a very destructive thing that they do. But the 10-year Treasury yield is in fact now 4.21%. So we go back to my scorecard. Okay, so US CPI, Goldman Sachs Commodity Index, and 10-year US Treasury yield on today, October 23, 2022. And what is the answer? As we saw, 2.5% for the CPI, so still below 3% and moderating. It's going to take a lot for this to go above 3%. Goldman Sachs Commodity Index, it is in deflation. It's very volatile. It can move around quickly, but it's in deflation, nowhere close to 3%. And we are very close to an age in the history of human civilization where almost no amount of money printing, or even literally no amount of money printing, can make this go up at 3% a year under this measurement. And then the 10-year US Treasury yield. Yes, this one is well above 3%. It is a measurement of future inflation, but this is extremely bearish for the US housing market, as well as for the US federal budget deficit. It's very bearish for all that and is putting a lot of pressure on the stock market, which could cause a stock market crash, as I speak about in other videos on this channel, but also reduces inflation by a lot. So this getting higher puts a lot of pressure on these other two as well. So only one of the three metrics is above 3%. Keep that in mind when everyone talks to you about inflation and uses very anecdotal evidence to prove that inflation is much higher. Remember, the rigor of their research about inflation is tantamount to saying that their wife's boyfriend's parole officer heard that the price of something rose and therefore we are about to die from hyperinflation. Don't listen to those people. If you found your way to this channel, you are way ahead of the curve and have a lot of resistance to the programming that the financial media is inflicting upon the masses. Now, if you like this type of content and would like to see more videos of this type, I encourage you to subscribe to this channel and hit the notification bell. Thank you very much for watching.